the reason why I'm so optimistic about multifamily assets in the long term is that one, we have that shortage where we're 3 to 7 million units short nationwide. Second is if you're buying in markets that have the right demographic and job growth, you're going to be having strong forces at your back for price appreciation and good rent growth.
This is Directly Invested for investors who want more than spreadsheets and speculation. No hype, just honest conversations to help you invest with purpose. This podcast is brought to you by Tamarack Capital.
All right, today we're going to be diving into what is the status of the real estate market, where we think it's going to be going in 2025, 2026, and 2027, and really what happened over the past really 10 years since the great financial crisis. I guess that's 15 years that got us to this situation. So I'm here with our head of operations, Max Schneider, our partner, and we're just going to jump right on in and see where we're at on the market. So looking back at the 20 teens, I guess you'd call them, the period between the great financial crisis and up to the pandemic, had 10 years of really a great time to be investing in multifamily. We just gone through this big super cycle recession, and there was a lot of buying opportunities. People were looking at what's called the 2% rule, where if you could buy a property where your monthly rent is 2% of the purchase price, that's just a quick and dirty rule of thumb to know that this is probably a pretty good investment opportunity. There's really no way to find that good of a deal anymore. So now people are looking at what's called the 1% rule. And this requires a little bit of a sharper pencil, but it just goes to show how much of a buying opportunity there was coming out of the great financial crisis. And that's where I got my start in real estate investing, buying duplexes back when, all the inventory wasn't getting bought up and bid up. Period. Really just saw some nice price increases, rents were increasing, and people were building equity at a pretty stable rate. That all changed when the pandemic hit, and that changed for a couple of reasons. It was the start of this big price bubble, and prices were being bid up for a couple of reasons. The first is everyone is stuck at home, and so you had a lot of roommates who were wanting to maybe move and get their own spot. People were moving out into larger properties, and this created a lot of demand that was driving up rent price increases. Couple that with the Federal Reserve wanted to try and help this spur the economy going during the shutdowns. And so interest rates were the lowest that they've almost ever been historically. People were borrowing with, 3.5%, 3.25% commercial rates. And the combination of high speculation, high rent increases, and low cost was really driving this insane appetite for multifamily apartments and bidding up prices. And Max, you and I didn't really start working together until 2023 on multifamily. And so I'm just curious what your perspective was being on the outside. You saw me working in the multifamily space. Did you see much of or have a feeling for what was going on in this bubble era?
Just more jealousy, I guess, watching you duplexes rise in equity and value while we were investing all of our money in startups. But no, honestly, the little bit of exposure that we had was just really looking at our own house and, like I said, watching our own small portfolio increase. We bought a house for $160,000 in 2017, and then by 2020 we were able to sell it for $225,000 or $250,000. So just a crazy amount of appreciation, and in that little house, just maximizing that or seeing that, extrapolate to multifamily was just incredible. So
It was a crazy time. And no, you're exactly right though. The two factors that were driving this price increase equally applied to single family houses too. People were wanting home offices, bigger places, and they could get, I think sub 3% mortgage rates were pretty common. And so we saw inflation of the price of these assets across the board. And that all came to a halt in 2023 when inflation was starting to really ramp up. And to get inflation under control, they started jacking up interest rates by about 5%. What happened was, in the low interest rate environment, you could have cash flowing properties even if you're paying very high prices for them. So we look at cap rates, right? Which essentially what's the uh, profitability of the property divided by the purchase price. And for context, right now we're about 6% cap rates for the properties that we look at. And during the 2021, 2022 period, you're seeing cap rates down at like the low 4% or maybe even high threes, as people were really building a lot of speculation, and they could borrow debt at 3.5%. That all came to a halt. And were you involved in the multifamily when they increased the rates? I think you had not quite gotten in yet, right?
Yeah, I mean, we were for half of it. I think when we first started, I mean, interest rates had already started creeping up. I think they were in the low fives, and then they went up another 150 basis points or more. And during that first year, I mean, we had that property in Pullman under contract in April for was it April for 5.75, and interest rates went up about what 75 bips from that point.
Yeah,
during the
that's right.
during the hold period. And our lender luckily held that rate for us over that period of time. So yeah, so we not when they initially started going up, but definitely the continued going.
You came in right at the tail end of that. Yeah, and this was a huge psychological hit to the market. I remember there was a fierce debate about whether this inflation is transitory or not. And I really thought that, we were going to see that spike in interest rates, get inflation under control, and then we'd go back to the low interest rate environment that we've been in for the past 15 years, right? I mean, so many careers were built when they'd never seen interest rates higher than 5%, right? And the entire market, I think, also had this psychology where, there were slogans like survive till 25 or persist till 26, because everyone thought that interest rates would drop, cap rates would compress, and purchase prices would go back up to what they were during the bubble period. And you saw this very prominently in seller expectations. They wanted to get their prices where they were. They were getting cold call left and right in 2020, 21, 22, and all of a sudden, they were the hot girls at prom, and then all of a sudden the music stopped, and they weren't going to lower their prices if they didn't have to sell. So what happened was buyers couldn't afford these prices anymore because the cost of capital was so much higher, and sellers didn't want to sell if they didn't have to. So what happened was in 2023, transaction volume dropped 80%, which is insane. The entire industry went through a huge, I mean, I wouldn't call it a depression. Anyone who made their money off of transaction volume had trouble staying in business. You look at people doing mortgage origination, insurance, the brokers, everyone got hit. And that really leads us into where we are right now.
Expectations are slowly realigning. However, I mean, we're still seeing some, interesting, sales that are, in the high fives, low sixes, where, ideally, you want to have your cap rate above your interest rate. Mm-hmm. And I assumed by now we would be seeing more of that in the sevens, high sixes, low sevens. And I think surprisingly, we're not seeing as much as that as I would have expected at this point.
Yeah, I think that there's still, that just goes to show how strong demand is for these types of assets. And if we're starting to look at the future and what 2026 and 2027, even up to 2030 might hold, I think there's some interesting dynamics at play here. One is, even 15 years after the great financial crisis, we're still having a systemic shortage of housing. There's a lot of different estimates out there, but they range between 3 million to 7 million units, housing units short of what the market actually needs. And right now, I think we're only building about 200,000 in excess supply a year. So that's going to take another decade or two to recover from. And everyone is feeling this, from the affordability of rent, the affordability of trying to buy a new house if you're a first-time home buyer. This is a real problem, but that problem is good if you own multifamily, because you're going to benefit from sustained demand for your units that's going to generally be outstripping supply over the long term. So maybe it gives a little bit of a speculative appetite for these types of assets. But we also have some headwinds. 2024, we started seeing our first rate decreases. And I thought, and I think everyone else thought that, okay, we'll probably see a steady decrease of interest rates.
Right. Everyone hoped.
Our policy at Tamarack was to never bake that into our underwriting. We always assume this can be flat, and we stress test for interest rates being higher to see if the project still makes sense. But that has really gone. That assumption has gone out the window. I think right now with the new administration's policies being tariff heavy, uh, that could spur more inflation, and we could see sustained higher for longer interest rates. So
Right.
I think anyone in our position, I mean, you do so much of our underwriting, we got to keep the interest rates
Yeah, and I
assumptions
think
high.
that's for better or for worse. I mean, me coming in at the tail end of the interest rate hikes, I only know what I know, and so I haven't seen interest rates on the multifamily side in the fours and low fives. So from my perspective, conservative in underwriting, not speculating that rates are going to go down, because again, in my short history, they've only gone up. Maybe there's a slight decrease. 25? Did we have a 25 BIP drop or
Mhm.
last year? And maybe we'll get one in Q3 of this year. We'll see. I On the positive side, assuming we can close deals at the conservative rate, and rates do go down, that's only further upside for us. But again, we don't know what we don't know, and anyone who can forecast that, they'd be trillionaires, and I don't think there's too many of those out there right now.
Yeah, yeah. The potential for lower rates definitely has some icing on the cake, but nothing that we can assume there. And I think this whole new bout of uncertainty over the past, I mean, we in Q2 had, I think it was April 2nd, the Trump administration announced the Liberation Day, and we had just gotten the property under contract the day before. And I think that, with Liberation Day and the implementation of tariffs, is going to have a really big impact on two areas of real estate. One is if material costs go up, then replacement costs will naturally be increasing,
Mhm.
which is going to support higher price points down the road. And then higher tariffs are essentially a form of taxation that creates inflation. And so the Fed is right now under pressure to be maintaining uh, interest rates higher. So, so we're seeing that with the advent of tariffs, there could be even more pressure for the Fed to be keeping interest rates higher for even longer to try and tamp down any inflationary factors that tariffs could bring in there. So I think that if I kind of bring this full circle, we saw how the real estate market has gone through a larger cycle since the great financial crisis, a mini rapid cycle with the pandemic, inflation, asset bubble, and then it's popped. And so the market's resetting right now. But the reason why I'm so optimistic about multifamily assets in the long term is that one, we have that shortage where we're 3 to 7 million units short nationwide, and second is if you're buying in markets that have the right demographic and job growth, you're going to be having strong forces at your back for price appreciation and good rent growth.
Right. I mean, it all comes down to location, 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 right? So if that's your first and foremost, what you're looking at, if your asset's in a great location and in a growing market, there certainly are tailwinds behind you. And again, having this long-term conservative, interest rate approach, there's definitely opportunity to win in real estate, like there has been for the last 150, 250 years. So, we're optimistic. It's slower than what I think we would like it to be right now. Um, Also, we're not giving up, and we're certainly excited about the future opportunities.
Yeah, and you're seeing the prudent syndicators like us. They're doing way fewer deals than they used to do. And right now, I mean, I know one that we really respect. They just got their first deal under contract for 2025. Likewise for us, the last deal we closed was in December of 2024. We're out there hunting, writing offers that we like, and when one sticks, we'll be excited to bring it to the group. So thanks for joining us.